Hello and welcome. Today we have John Adams, an independent economist. We're excited to have him on today to talk about the Australian economy as well as interest rates, which is a hot topic at the moment. John, welcome to the show.
Thank you for having me.
Our pleasure. Well, let's start off with talking about your prediction in 2018 and how that come to pass in the last couple of years.
So I actually wrote an article in 2018 for news.com where I provided a number of scenarios as to what I think was going to happen with the Australian economy. And the concern I've had for many years has been that we have too much household debt and too much foreign debt. And the household debt obviously is linked to the property market because most of the debt that households carry are in terms of mortgages. So before the pandemic, I was sort of hedging my bets. I said we could see a huge property crash, or we could start, or if we had runaway money printing, we could see property prices go even higher. So then we get to so before 2020, I was sort of talking about the potential for a big crash, but also said there was a potential of it going the other way. When we get into March of 2020, and so as the pandemic starts in February of 2020, we see the stock market crash 35%. A lot of people panicking about what's happening in the financial markets. Lockdowns are happening, dramatic announcements around COVID-19 in terms of health measures, etc. Then we get this coordinated press conference by all the central banks around the world, the RBA, the US Federal Reserve, Bank of England, the Central Bank, the Reserve Bank of New Zealand, etc. And they all basically said we're going to print as much as we need to basically stabilize the markets. And so they basically effectively gave the signal of QE to infinity. And once they announced that, and you could see all these politicians around the world willing to spend, billions, if not trillions of dollars trying to stimulate the economy while we're going through this pandemic. It seemed pretty clear to me that what they were trying to do was they were basically trying to keep the debt bubble together, but particularly in the Australian market, they were going to put a floor under property prices. So when I saw that sort of situation playing out, that's why in June of 2020 I did a video with my co-host Martin North on our YouTube channel, In the Interest of the People, and I said property prices are unlikely to collapse in terms of the next 18 months. And so that call was pretty much right. And even though during that period of time there was a lot of nervousness, a lot of people saying that the market was going to crash. And it was going to be pretty bad. It seemed to me that it was going to, they were going to throw as much as they can to it, and they were going to stabilize the market, and that's exactly what happened.
And we're seeing a similar trend with interest rates rising at the moment. So I'd love to hear where you see the market going in 2022 and beyond.
Sure. Yes. So I mean, because I'm a bit of a contrarian sort of person. I mean, I've been very critical of the policies of our central bank, but also in terms of the former Morrison government and some of these state governments. So during this whole period of time when money was super cheap, with 0.1% interest rates and quantitative easing, yield curve control, and giving the banks cheap loans with its term funding facility. I mean, mortgage rates went down as low as, you're in a good position to know, but about 1.8, 1.9%, a lot of people were borrowing. And that drove property prices. My forecast in 2020 was that property prices were not going to collapse, but they didn't just stabilize; they went up about 30%. And obviously, for real estate agents, in terms of yourself, it was a good time to be in the property market because there was a lot of activity in the market. Now, as we start to see in the last 4 weeks, we've had two decisions from the RBA to raise interest rates, and so they went up 0.25, and then only 2 days ago at 0.5%. So what we're going to start to see is a huge reversal in terms of the property market. So we're already starting to see, particularly here in New South Wales, we're starting to see a huge psychological change in terms of what people are willing to, in terms of spend, their ability in terms of what they can borrow from the banks. And property prices ultimately are going to be driven by basically not only part of it's psychology and sentiment, but from a mathematical point of view, it's all driven by how much credit will the banks create and how much can people borrow to basically in terms of property. And so speaking to my local credit union only in the last few weeks, they said last November I mean, everyone was borrowing as much as they could. They were borrowing hand over fist. They were going into the market and bidding on property, and not being very prudent about those decisions. And now, as rates start to go up, and I should say, one of the reasons why people felt comfortable being aggressive in bidding in the property market was because the guidance from the RBA governor was that rates were not going to go up until 2024. And so now that they've broken that promise, and a lot of household, both owner occupiers but also property investors took those statements on face value, a lot of people are going to be caught short. And so the question is that obviously there's an inflation problem. The RBA is now trying to overcome that problem by raising rates. Now, some of the inflation, if you look at the recent CPI data, is driven by the cost of housing materials, and we've got a housing market that is red hot. And that's why we have some supply chain problems. But then we also have huge problems overseas with the war in the Ukraine, and that's driving oil prices higher. So there's raising interest rates will have a impact around inflation. It's not going to solve the entire problem. And so in the next 6 months, in particular, as they aggressively try to raise rates, and just to give your listeners a bit of an example. If you're on $1 million mortgage over 25 years, the last 2 rate rises in 4 weeks has meant that you've got to now pony up another $4,700 in terms of additional repayments. And we're only another 4 weeks, and Westpac came out yesterday saying that rates are going to go up another 0.5%. So what we're going to see as we go to July, August, maybe September, is that and again, maybe Queensland's a little bit different, but in Sydney and Melbourne, lots of families have got $1 million plus mortgages, and within the course of 2 to 3 months, they're going to be asked to pony up another $11,000 to $13,000 in terms of additional repayments, and that's going to be a huge ask for a lot of in terms of a lot of households. So there will be some dramatic pain in the property market. I think. Construction's going to basically come to a standstill. Commercial, so I think where you're going to start to see some initial weakness is in both in terms of commercial property, but also in terms of property investors. There's going to be a rush to the door to try to sell property. There's only in the last couple of days that the Financial Review reported that there's a lot of property on the market that hasn't cleared and it's been sitting on the market for more than 6 months. So there's a lot of vendors out there that haven't come to terms with the new environment, and they're not willing to cut their prices yet. So I think there'll be a day of reckoning psychologically where a number of vendors will have to sell, and there'll be some losses to be had. And obviously in the owner-occupier space, there are some banks already tapping on people's shoulders and saying, you're in bad financial state, you've got to basically sell your house, otherwise we'll go through a mortgagee repossession. So that process is happening. But now, if we were to continue along the path that we're on, and they don't stop, we're going to go into what happened in terms of Ireland with the Irish housing crisis, and we could see a full-on 50% collapse in property prices. We could easily see the banks going bust and a full-on deflationary depression. Now, my thesis that have come out in the last few weeks is that the government and the RBA don't want that to happen. So they want to tackle inflation, but they're not suicidal. They're not going to basically destroy the banks. They're not going to destroy the financial system. So that's why they're going to raise rates up to a certain point, and we don't know what that point is. And even the RBA has said they don't understand the full impact of rate rises on the household sector. So they're going to raise rates, they're going to pause, and then they're going to start cutting again. And when they cut to keep the bubble going, they've got to print and inject more stimulus than what they did in 2020 and 2021. And that's why I think we're going to likely see rates going down next year. And obviously in terms of New Zealand and in terms of the United States, they're already forecasting a number of market analysts to say that rates will come back down next year. And then what I think we'll see in 2024 is potentially negative interest rates. And APRA, the Australian Prudential Regulation Authority, has already foreshadowed with the commercial banks to get ready for negative interest rates. And I think what we're likely to see, even though I don't necessarily agree with this policy direction, if people were borrowing last year at 1.8, 1.9%, I wouldn't be surprised if we saw mortgage rates in 2 years' time at about 1.5 to 1%. So mortgage rates even lower than we were in the pandemic. And I think in that environment, you're going to see a lot of aggressive borrowing, even more than what's happened in the last couple of years. And with that aggressive borrowing, you're going to see property prices go even higher. So I think while we're going in this rate rise, there'll be pain. Then there'll be a pivot, and then there'll be an easing cycle again. And in that easing cycle, I think property prices will go higher compared to where we were last year.
Yeah, which is kind of what happened. I remember in the 2007, 2008, 2009 cycle where rates went up pretty aggressively in a short period, and people sort of jumped on fixed rates of 8, 9, I did it myself, percent, thinking that rate's going to go to infinity, and then they ended up dropping back overnight. So it sounds like that could be the sort of thing. And I guess I know you've spoken about it before, where the importance of sort of having the buffer, trying to think ahead as well. I was watching one of your other videos recently, and it's easy to kind of look at the rates as at today, but potentially building a bit of buffer there and where they could get to and potentially come back to.
Yes, I mean, look, so I mean, one of the things about the buffer is that now there's a lot of debate out there in the marketplace over the last 48 hours about how big are the existing buffers. So when people now, like in terms of APRA, they changed their policy last year. So I think in the first half of last year, when a mortgage holder went to go get when they went for their mortgage application, they got assessed. They were required to be assessed by assessed with a buffer of 2.5% higher than what the current interest rate was. Then APRA changed it to 3%. So there is a view out there that people are fine at the moment, and people can absorb another 2%. But once the rates go above 2% from where we are now, that's when the pain's going to start to hit. So that's one view. But then obviously my co-host Martin North, who has a unique data set that he contracts a professional polling company to go collect household cash flow data. He's basically saying that there's a lot of people in pain today, and that mortgage stress is at about 43% with these in terms of these low record rates. But he's thinking that with inflation raging, with interest rates going up, mortgage stress could easily go to 50-55%. So it'll be very interesting to see how this unfolds, because a lot of one of the interesting cultural phenomena about Australia is that when people are down on their luck in this country, people don't like to tell people. So when you're a market analyst like me, or if you're a policymaker, or if you're someone like yourself in the real estate market, and you're trying to get a feel for what's the real situation in the in terms of the Australian economy, because a lot of people don't want to open up about their real financial situation. I mean, there's a lot of speculation, there's a lot of guesswork, but in reality, once the rubber hits the road with these rates going up, then we're going to see the real situation unfold. And yes, so I think I'm probably in the Martin North camp. So I think that household balance sheets are way worse than what a lot of bureaucrats and a lot of politicians actually think that they are, and so that'll be that's going to be one of the big questions that's going to unravel over the next 6 months, and we'll see who is financially sound and who's basically in a bad financial spot.
Yeah, I guess we'll have to see how that plays out. And I guess back on interest rates and sort of a normal level, like if you're saying sort of over the next couple of years, they're going to kind of go up and potentially go down, is the new normal, I guess, rates in the +1 or 2% kind of from where we are today. Like, it doesn't seem that we're back to the 7-8% days sort of 10, 15, 20 years ago I guess at this point.
Well, I mean, probably a couple of points there. One of the points I'll make is that only this morning did you have an article in the Financial Review that said that the former RBA Governor Ian Macfarlane is forecasting the official cash rate to go to 4%. And so you think if a cash rate of 4% and they're going to do quantitative tightening next year, you could see a mortgage rate at 7.5%. So and most people borrowed at 1.8, 1.9%. So the reality, look, I mean, I don't think that situation is sustainable, and that's why I think the pivot's coming. But in terms of where rates are going to go, I mean, so ultimately, if we raise rates and the economy weakens and we potentially go into recession and then they start to cut rates, well, what they want to be able to do is to cut rates to a level that economic growth goes back up, but also the unemployment level stays at a particularly low level. Now, when you look at the most recent GDP statistics from the Australian Bureau of Statistics, the bulk of economic growth is driven by household and government spending. And why are they spending? Because of debt. So if you're going to drive in the next cycle, if you're going to drive economic growth by getting households to spend, you need to give them more borrowing power so they can borrow to fund that spending. So what's that rate of interest that has to be so that you can get even more borrowing out there? Every time you go through these cycles, interest rates keep on going lower and lower and lower because you can't go back to where it was before, because that's not going to give households more borrowing power. So to give households more borrowing power, that's why mortgage rates have to go lower than 1.8%. And so that's why I think to get mortgage rates at 1.5 to 1%, you're going to drive interest rates, or you're going to drive interest rates like the official. I want to say interest rate, the official cash rate, you're going to go negative. So that's what I think the new normal is going to be in terms of what the next rating cycle is. But that whole policy mix, to my mind, is a short-term fix, and it's not really sustainable. And so that's why in a number of my controversial shows that I do with Mar North, I basically say, it's time to pop the bubble. It's time to raise interest rates and push the economy into a depression, and basically crash the property market on purpose, and result in a crisis in the banks, so that you can reorganize the banks. Because the only way to get the economy on a sustainable economic footing is you've got to shrink the debt. And obviously that means there'll be a lot of pain in the real estate market, and obviously with the property agents like yourself. But that's the ultimate way that you get a sustainable economy. But because the governments and the RBA and APRA and the banks don't want to do that, all they're doing is from crisis to crisis to crisis, and they're using these band-aid solutions. So what's the rate of interest that will happen in the next cycle as they ease? I mean, it's hard to know. But what they need to do is basically give households more borrowing power. That's going to drive economic growth higher through higher consumption. And how that plays out next year and the year after, we'll just have to wait and see.
And I guess to your, just on a point earlier that you've made, just on negative interest rates, it was something that came up, I guess over the last couple of years, where there was the Scandinavian country that had negative home loan rates. And so how would you actually see that playing out? Like, is that even plausible? I know they've kind of prepared for it in the Australian economy, but like, what would that actually look like?
Sure. Yes. So just to give your, in terms of your audience, a bit of context. So last year, APRA gave, I think in July of 2021, draft expectations to the commercial banks to get ready for negative interest rates. And then in terms of late October, they drafted their final expectations. And so they basically said by October 2022, every bank in Australia has to be not only in terms of prepared, but they have to have the operational capability to implement these so-called tactical solutions in terms of negative interest rates. So they're basically saying by October this year, if negative interest rates occurs in Australia, you have to have all the product, you have to have all the legal documents, you have to have all the IT systems, you have to have the staff trained, you have to have everything ready so that you can start to implement this. So negative interest rates, I think, is going to happen. And the fact that APRA basically pushed the banks into this program last year, I mean, I think they really sort of revealed what the real agenda is. I mean, one of the interesting insights that I picked up from Mar North is a lot of his contacts, and in terms of particularly in terms of the big four banks who work in middle management, they're all scratching their heads this year thinking, why are we being pushed to prepare for negative interest rates when we've got raging inflation and we've got all this talk about interest rates going up. And so the reality is that while interest rates going up, I mean, that's not the real game. The real game is negative interest rates going into negative territory. So what does that mean? So the commercial banks have reserves at the central bank. And obviously in the context of Australia, it's the Reserve Bank of Australia. And so if you look at what the announcement, what happened on Tuesday, what the RBA is saying is, so these reserves are in accounts called exchange settlement balances. And so they've raised the rates on those, and they're saying to the bank, if you put money in your account with the RBA, we're going to pay you 0.75%. Whereas what a negative interest rate will do is that they'll basically, the RBA will charge a negative interest rate on the commercial bank and say that if you want to keep your money at the Reserve Bank, rather than us pay you interest, you're going to pay us a rate of interest for the privilege of having your money at the bank. Now, why would they do that? The purpose of negative interest rates is that they want the commercial banks to take their money out of these exchange settlement accounts and then go lend that money out into the economy. And obviously, if the banks are flushed with cash, they're going to drive those interest rates even further down. And so now, yes, you are correct that in the case of Scandinavia, negative interest rates reached such an extreme level that not only did saving products go negative in terms of the retail interest rate, but also there was one bank where they had a negative mortgage rate, which makes no commercial sense. Why would any commercial bank pay a borrower to borrow money? I mean that was just completely nuts. So I think where we're going to see the negative interest rates really come in is between the RBA and the commercial bank. So whether that results in retail negative interest rates, I mean, we'll have to wait and see how that all plays. But I think the impact will be that you're basically going to get nothing on your saving products, and then in terms of your mortgages, they're going to try to drive the mortgage rate lower than where we were in 2021.
No, really, yeah, interesting. I guess we'll have to see how it's going to play out. So, John, appreciate your time. That's been really insightful. How can our viewers find you if they want to look at you online and YouTube?
Sure. So the main YouTube channel that I'm on is In the Interest of the People. So people can see my content with Marta North. I am in the precious metals industry, so I work for South Australia's largest bullion dealer, As Good as Gold Australia. People can look me up there. On Twitter, my handle is Adams Economics. I have a group on Telegram called Adams Economics as well. I have my own personal website, Adams Economics, and people can find me on that, read some of my published work, and if people want to email me and ask me any questions, feel free to, and my email address is john@adamseconomics.com.
John, thanks so much for joining us today. We really appreciate your time.
Thank you very much.
Guys, what did you think? Leave a comment below. If you haven't already, hit that subscribe button so you don't miss anything and you get more content exactly like today. If you have any questions, as always, hit us up at huntergalloway.com.au or call us on 1300 088 065. We help home buyers right across Australia. There's no cost for the service. We're based in Brisbane, but deal with people Australia-wide. We'll see you next time.